So in the last class, we discussed how the firm could hedge against interest rate risk. And we mentioned two methods. The first one is the duration-based hedging, and the second is hedging using interest rate swap. So in the case of duration-based hedging, the basic idea is the firm's purpose is to make sure the value of the equity does not change with the interest rate. So to achieve this, the firm will want to make sure the duration of equity is zero. And then, because equity can be considered as a portfolio of asset and liability, so the firm can adjust the duration of the asset and the duration of the liability to achieve the goal to make the duration of the equity equal to zero. So that's the duration-based hedging. And then we introduced swap-based hedging. And we finished this part on defining interest rate swap, right? So we want to understand what is the interest rate swap. And just from the name, you can see that it's actually a pretty simple concept. So if a firm is swapping one type of interest rate for a different type of interest rate, then we call this contract as interest rate swap. So here, more specifically, we focus on two types of interest rate. The first is the fixed interest rate. And the second is the market interest rate or floating interest rate. So we could have two kinds of scenarios. The first is fixed to floating, right? So if a firm enters into this contract, it basically means this firm will have to pay the fixed interest rate and it will receive floating interest rate. Or we could have the other case, floating to fixed. So in this case, the firm entering this contract will pay a floating interest rate to the other party, and the other party will pay the fixed interest rate to the firm. More concretely, you can imagine that we have two firms. Okay? So let's say we have firm A and B. And from firm A's perspective, right? So let's say from firm A's perspective, it enters into a fixed to float swap. Now, what the cash flow would look like? Well, basically, firm A, okay, let me use a different color. So firm A will pay fixed interest rate to firm B, and it will receive floating interest rate from firm B, right? So that's how the interest rate swap works. Okay, so today let's talk about swap-based hedging. And I mentioned this in the last class. So basically the idea is the interest rate on a firm's debt can change, either because the risk-free interest rate changes or the firm's credit rating changes. And if we combine swap with the firm's debt, the firm can actually choose which of these sources of interest rate risk they want to keep and which type of risk they will want to eliminate. Okay, now let's see an example on how this actually works. So Alloy Cutting Corporation, right, ACC, needs to borrow $10 million to make some investments. Now let's say the 6-month LIBOR rate is 4% and the 10-year interest rate for AA-rated firms is 6%. So here this 4% is essentially the market rate or floating rate. You can imagine that this 6-month LIBOR rate changes, let's say for every 6 months, right? It's like for the first 6 months you pay for the first 6 months you pay 4%, but at the end of the 6 months you will have to borrow a second time for another 6 months. Now this time maybe you will have to pay a LIBOR rate of 5%, right? And then for this 10-year interest rate, well, because this 6% is fixed for this 10-year rate, so we could consider that 6% as a fixed rate. Given ACC's low current credit rating, the bank will charge the firm a spread of 1% above these rates. So this basically means if LIBOR rate is 4% and if the fixed rate is 6%, ACC will have to pay additional 1% credit spread. So this means for ACC, its 6-month interest rate would be 4 plus 1, which is 5%. And if it decides to go with the 10-year debt, it will have to pay 6 plus 1, 7%. Now, ACC believes that LIBOR will increase, and it also believes its credit rating will improve over time. Right? So this is the firm's view about the future interest rate changes. And there are two components here. The first component is it believes the LIBOR rate will increase, but it believes its credit rating will improve in the future. So this basically means as the firm increases its credit quality, this credit spread will actually decrease, right? Obviously, the firm ACC has two kinds of choices. First, it can use this 6-month loan, and it will refinance every 6 months, right? So you can imagine that in this case, there is interest rate risk, because you can imagine that if it's a 6-month loan, then so for the first month to the 6th month, right, you pay 5%. And then for all these future 6-month periods, ACC don't know what kind of interest rate it will pay. It only knows it will pay this market rate, right? So maybe in the future, it becomes 6%, 6.5%, 4%, right? So let's say, so let's denote this 6-month interest rate as RT plus delta T, right? For example, for the first month, for example, for the first 6-month loan, its interest rate would be, let's say, R1 delta 1, right? For the second 6-month loan, it would be R2 plus delta 2. The key here is this interest rate changes with time t, which is basically the definition of floating interest rate, right? So here RT is LIBOR and delta T is the credit spread the firm has to pay because of its inferior credit rating. Now, the second choice is the firm can just use a 10-year loan. In this case, the firm can lock in the interest rate, which would be 6 plus 1%, 7%. So let's further examine these two choices and see what are the trade-offs of using long-term debt versus short-term debt. Okay. So for long-term debt, the benefit is the firm can lock in this low interest rate at 6%. So why do we say this? Well, because previously we mentioned the firm believes in the future, LIBOR, the market interest rate, will increase, right? It basically means now if the firm can lock in the 6% rate, then it is beneficial. But what is the downside? Well, the downside is the firm is paying 7% fixed rate, which means the firm is paying us 1% credit spread because of its bad credit rating. But the firm also knows that in the future, it will increase its credit quality, which means in the future, this credit spread of 1% should decrease. However, if the firm is using this fixed rate, this firm is essentially locking this high credit spread of 1%, right? So it cannot enjoy this lower credit spread in the future because of its improved credit rating. Now, for the second case, the firm would borrow every 6 months at the market rate. Now, in this case, what you can see here is the benefit is in the future, the firm's credit rating will increase. So this credit spread, delta T, will decrease. And if the firm refinances every 6 months, then this means as time goes in the future, the firm will get the benefit of lower credit spread delta T, right? So it can capture the benefit from its improved credit quality. But it's obvious you can find the downside. The downside is this guy here, right? This RT. The firm believes in the future the LIBOR rate will increase, which means in the future, if the firm refinances every 6 months, then potentially the firm will have to pay a higher LIBOR rate, a higher interest RT, right? So it could potentially rise above 6%. Now, it looks like the firm has a dilemma between the long-term financing and the short-term financing. Well, luckily, if we use interest rate swap, the firm can actually get these two benefits and remove these two downsides, right? So what's the general idea here? Well, the general idea here is if you look at this number, RT plus delta T, right? Imagine now the firm decides to go with this 6-month loan, right? And we understand that this is the benefit, right? This is the benefit or the good part because in the future, this credit spread delta T will decrease, right? But this part, this RT, is the downside. So let's call this as, just downside. Right? Because the firm believes in the future, this rate will increase. Right? So essentially it means if the firm is trying to design a strategy to capture the benefits, the firm will want to keep this part. Right? It will want to keep the benefit and it will want to remove the downside. Right? It will want to remove the downside, which means the firm will want to remove the market interest rate RT. That's the purpose here. Now, how the firm can achieve this? Well, interest rate swap, right? So let me write it down here because this is like the basic of understanding how this works. So the firm goal is to, let's say, get rid of RT, right? What tool the firm can use? Well, interest rate swap. Oops. To be more specific, what kind of swap this firm wants to use? Well, the firm wants to get rid of floating rate, and the firm wants to get the fixed rate, right? It wants to lock in the fixed rate. So the firm will enter a swap which can achieve this. So we mentioned there are two kinds of interest rate swaps. The first is, let's say, floating to fixed. In this case, the firm pays a floating rate and get the fixed rate. And in the second case, it's fixed to floating. So in this case, the firm pays a fixed rate and get floating rate. And in the 6-month loan, the firm is paying market interest rate. And the firm's goal is to get rid of paying this market interest rate, which means the firm wants to pay a fixed rate, right? So obviously, the swap that the firm wants to use is fixed to floating, right? If the firm enters into this fixed to floating interest rate swap, it means the firm pays a fixed interest rate and the firm will get a floating interest rate, right? Okay. Now, so ACC enters into a 10-year interest rate swap in which it agrees to pay a fixed rate of 6% per year in exchange for receiving this floating interest rate. Right? So it's a fixed to floating interest rate swap. So let's see whether the firm can actually achieve this using this interest rate swap. So before entering into this interest rate swap, the firm was paying this interest rate, right? The market interest rate RT plus the credit spread delta T. And now the firm enters into this fixed to floating swap. So in this case, the firm will have to pay this 6% fixed rate. And in return, it will receive this floating rate. So this will give us the net borrowing cost, right? So this is the original borrowing cost. And then it will have to pay this fixed rate, but the firm will get back this floating rate. So in the end, you can see that this floating rate, they will just cancel with each other. And in the end, the total borrowing cost or net borrowing cost would be a fixed rate of 6% plus the credit spread. And this is exactly the firm wants to have, right? Because it locks in this low interest rate and it can enjoy the decrease in delta T because of its improved credit rating. Okay, now let's see this example here. Both industries wants to borrow $10 million. So now the long-term AA rates are 10%. And both can borrow at 10.5% given its credit rating. The firm is expecting interest rates to fall over the next few years. So it would prefer to borrow at short-term rates and refinance after rates drop. However, both management is afraid that its credit rating may become worse. So in this case, it will increase the credit spread the firm has to pay on its debt. Now, the question is, how can both benefit from declining interest rates without worrying about changes in its credit rating? So basically the firm wants to enjoy this decrease in interest rates in the future. But it does not want this potential increase in credit spread because of its decreased credit quality. Now, this means the firm will want to lock in the current credit spread, right? So you can see that the spread currently is 10.5% minus 10%, which is 0.5%. And the firm wants to keep this, right? The reason is because, again, the firm expects in the future its credit quality will decrease, so it wants to get this, locking this nice 0.5% credit spread. So obviously, to do this, the firm will have to borrow this 10-year 10-year debt, right? Because that's how the firm can lock in this 0.5%. So the firm will have to, so first, the firm will have to borrow this 10-year debt at 10.5%, right? And in this case, we know that the 10% is the market interest rate, and 0.5% is the credit spread. And we know that the firm wants to keep this part. But the firm wanted to remove this part, right? The firm wanted to remove this part. That is, the firm wants to remove the fixed interest rate. It prefers to pay floating interest rate. The reason is because the firm believes in the future the market interest rate will decrease. So paying market interest rate is better compared with paying a 10% fixed interest rate, right? So in this case, you can see that the firm needs to enter into an interest rate swap, and in this swap, the firm pays floating rate and it receives fixed rate. So in this case, the firm will enter into this floating to fixed interest rate swap, right? And you can actually calculate the firm's net debt cost of capital after entering into this swap. So in the beginning, the firm's cost of capital is 10% of the market interest rate, right? 10% of the fixed interest rate plus the 0.5 percent credit spread. And then the firm enters into this floating to fixed swap, which means the firm has to pay this floating rate, but it will get back the fixed rate, right? So you can see that in this case, the 10% and 10% will just cancel out. And in the end, the firm's net or total debt cost of capital would be the market interest rate plus the 0.5% credit default spread. From firm's perspective, this is nice, right? Because this is market rate. The firm expects the market interest rate to decrease in the future, right? And this is also nice because this is a credit default spread. And the firm knows in the future its credit quality will decrease. So now it can lock in this 0.5 very low credit spread. So this is preferred. Okay. Okay. Now let's go back to the duration-based hedging. So recall that in the duration-based hedging, right, we talked about this example, the Northland Bank. And we said the Northland Bank wants to immunize its equity from the interest rate risk. That is, the bank wants to make sure the value of equity keeps the same even if interest rate changes. And in that example, the method we used is we sell the firm's assets. To be more specific, we sell the firm's mortgage for cash. And we know that mortgages have longer durations and cash have zero duration. So by selling mortgages for cash, we successfully reduce the bank's duration of asset. And in the end, by doing this, we can make sure the duration of the bank's equity is zero, right? So through this, we achieve the goal of immunizing the bank from the interest rate risk. And now we could achieve the same result by using interest rate swap. So you can see that this is beneficial because to achieve the same result, we don't need to sell any assets, right? So this is much more convenient than the duration-based hedging. Okay, so to understand this, let's first look at this interest rate swap. So let's consider a 10-year, $10 million interest rate swap with 6% fixed rate. Right? So 10-year, and the notional principal is $10 million and 6% fixed rate. So let's consider a firm, right? Let's consider a firm. So this firm enters into this interest rate swap and it receives the fixed rate. So in this case, it's floating to fixed interest rate swap. That is, the firm is paying this floating interest rate. So let's assume we're talking about 6-month market interest rate. And by paying the 6-month interest rate, the firm is getting a fixed interest rate, right? So this is a floating to fixed interest rate swap. And the claim here is we want to say that this swap is equivalent to a long position in a 10-year bond with 6% fixed rate and a short position in the 6-month bond with this 6-month market interest rate. So why? How do we get this result? Well, because these two cases, they have the same cash flow, right? Remember that in the floating to fixed swap case, the firm is paying this 6-month market rate and getting this 10-year 6% fixed rate. And in this case of selling bond and buying bond, right? If the firm is buying this 10-year bond with 6% rate, then this firm will get this 6% fixed rate. And if the firm is selling or taking a short position in the 6-month bond, then the firm will have to pay this 6-month market interest rate, right? Again, if you look at this case, right? The cash flow here is the firm will get 6% rate, but it will have to pay this 6-month market interest rate, right? And this is exactly the case for the swap. The firm gets 6% rate and it pays 6-month rate. So the interest rate differentials or the cash flows, they're the same in the swap case and the bond portfolio case. Right? So that's why we have this result here. So let me repeat. For the party receiving the fixed rate and paying the market interest rate, this swap is the same as buying a 10-year bond with a 6% rate and selling a 6-month bond at the 6-month market interest rate. And because the interest rate has a notional principal of $10 million, then both bonds will have a face value of $10 million. Okay, now let's look at the case for the party paying the fixed rate. So let's use this as a practice, right? So let's say now the firm, so because the firm is paying the fixed rate, now you can see that in this case it's fixed to floating swap, right? So the firm is swapping a fixed rate for a floating rate. Now the claim is the swap is the same as a short position or selling, right? Short, well, because taking a short position is the same as selling in the case of bond, right? So taking a short position in a 10-year bond with 6% interest rate and taking a long position in the 6-month bond with a 6-month market interest rate, right? Again, why do these two things are the same? Well, because they have the same cash flow, and you can verify this pretty easily. So in the case of fixed to floating swap, the firm will be able to get a floating rate. So let's say it's the 6-month rate. And it will have to pay the 6% fixed rate. Right? So that's the cash flow for the swap. And then in the bond case, if the firm is selling the 10-year bond and buying the 6-month bond, then it will have to pay this 6% rate. And by taking a long position in the 6-month bond, it will be able to get paid by the 6-month interest rate, right? So again, you can see that these two cases, they have the same cash flows. So that's why we say that for the party paying the fixed rate, it is equivalent to be short or selling a 10-year bond, and to be long or buying a 6-month bond. Okay, let me be repetitive here because I think this might be confusing, so it's worth repeating. So to summarize, for the party receiving the fixed rate, a swap is the same as a long position in the long-term bond and a short position in the short-term bond. Each bond with a face value equal to the notional principal. And then for the party paying the fixed rate, a swap is the same as a short position in a long-term bond and a long position in a short-term bond. Again, each bond has a face value which is the same as the notional principal of the interest rate swap. So to make this argument, you just need to find out what is the cash flow from the swap and the cash flow from these bond positions. And you will find out that they have the same cash flows. So you will be able to understand the equivalence argument here. Okay, now we could formally talk about hedging with swap. So first, what's the basic approach here? Well, we know that we can consider a swap contract as a long position in one bond and a short position in another bond. So this implies that a swap contract can change the duration of a portfolio based on the difference in the duration of the long-term bond and the short-term bond. So swaps will be a convenient way to change the duration of a portfolio without buying or selling assets. So that's just the basic intuition here. And in terms of how to actually solve this or better understand, we could look at the example here. So again, we're talking about the Northland Bank example. So let's say again the bank wants to make sure its value of equity would keep the same even if interest rate changes. And instead of selling its assets, now Northland Bank will use an interest rate swap. So let's say the bank enters into a 10-year interest rate swap. And in this swap, the bank agrees to pay a fixed rate of 6% per year in exchange for the 6-month floating rate. compute the correct notional amount of the interest rate swap. Okay, now how do you solve this? So first, let's understand why the firm wants to do this, right? So here the problem says the firm will want to enter into an interest rate swap. In this swap, the firm will pay a fixed rate and it will receive 6-month market rate. So in this case, we know that for the bank, it enters a fixed to floating swap contract, right? And we understand that this swap is equivalent to a long position in the 6-month short-term debt and a short position in the 10-year debt, right? Again, to say this, just look at the cash flow, right? Because if you have a short position in the 10-year debt, then you will have to pay this 6% rate for like 10 years. And then if you have a long position in the 6-month debt, then you will get this 6-month market interest rate, right? And then you can see that the swap has the same cash flow as this bound position. Now, if you have a long position in the 6-month debt and a short position in the 10-year debt, this basically means you're selling long duration debt for short duration debt, right? Again, if you're taking a short position in 10-year debt, then this is equivalent to say you're selling this long-term debt. And then you have a long position in the short-term debt. Then this is the same as you have you have bought the short-term debt. So essentially, by entering this swap, the bank is selling long-term debt for short-term debt, right? And now you can see the idea here. Previously, the bank has to sell mortgages for cash, right? So the bank is actually selling long-term debt for cash. That is reducing the duration of the asset. And here, selling long-term debt and buying short-term debt, again, it's about reducing the duration of the bank's asset, right? So it's the same idea here. And now, let's go back to the question. You need to compute the correct notional amount of the swap. And we know that the notional amount of the swap would be the same as the face value of the debt, right? So essentially, we wanted to solve the face value. That is, how much the firm wants to sell its long-term debt and how much the firm will want to buy this short-term 6-month debt, right? So now we will be able to use the previous formula. So let me go back to the formula. So we will want to look for this formula. The amount to exchange will tell us the notional principal. Right? So next, we need to find out the change in portfolio duration, portfolio value, and the change in asset duration. And we have solved this similar problem in the last class. And we know that The change in portfolio duration is, here again, portfolio refers the bank's equity. And we know that the bank wants to reduce the duration of the equity from 40.7 to 0. Right? So it's 40.7 minus 0. Portfolio value is essentially the equity value. It should be $15 million. What is the change in asset duration? So what is the asset here? Remember that we said this swap is equivalent to the case that you're selling the long-term 10-year debt and you're buying the 6-month debt. So here, the asset duration would be the duration of the 10-year bond minus the duration of the 6-month bond. Right? So let's say this 6-month bond is a discounted bond, so it has no coupon. Now in this case, its duration is just 0.5 because we have 12 months, right? So 6 months, which is 0.5 years. And then the 10-year bond has a duration of, we actually have solved this. So let me go backward and look for this number. So we solved the duration for this 10-year bond in table 30.4. So its duration is 6.76 years. So it's so it's 6.76 years. And now we have all these numbers, and we can solve the amount to change, which is the notional principal of the interest rate swap. So let's see the answer here. So it's $97.5 million. So which means instead of selling mortgages, Northland Bank can simply enter into this interest rate swap with a notional principal of $97.5 million. Okay, now let's look at some review questions. Okay, first, how can insurance add value to a firm? So we discussed this in the first section. So basically there are multiple values that insurance can add to the firm. So the first one is insurance can reduce the financial distress cost. Right? Well, because without insurance, if bad things happen, the firm could have some cash shortfalls, and in this case, the firm could suffer from the financial distress cost. But with insurance, the firm doesn't need to worry about this, so there would be no risks of financial distress costs. And then we also learned that insurance can reduce the insurance cost, and it can increase the firm's debt capacity, and it can also reduce the firm's debt cost of capital. So here the basic idea is insurance can reduce the firm's risk. So because the firm's risk is lower, then the firm can take on more debt, and the cost of debt will also be lower. So what else? Insurance can reduce tax rate changes, or insurance can smooth a firm's earnings. So the basic idea here is if the firm pays a higher tax rate when it pays the insurance premium, and a lower tax rate if the loss occurs, then in the end, the net result of this insurance is the firm will be able to enjoy tax savings. And what else? Oh, insurance can help the firm to better manage its risk, right? So the idea is insurance firms, they have more skills in assessing risks and understanding risks. So they could help the firm to manage its own risk. Okay, identify the cost of insurance that arise due to market imperfections. So first, if the market is perfect, then we know that the cost of insurance is always this fair premium, right? So you will basically discount the expected insurance payments. And this discounted value will be your cost of insurance. However, there are market imperfections, and this will increase the cost of insurance. So there are two major types of additional costs. The first is transaction cost. It basically means if you want to buy insurance, then most likely you have to buy from an insurance firm. And this insurance firm will have its own cost. So this will increase the insurance cost. And the second type of additional cost is the informational cost. There are two reasons. The first is adverse selection. It basically means that a firm with high risk is more likely to buy insurance. So this will essentially increase the potential of insurance payments from the insurance firms. So insurance firm will have the incentive to increase insurance cost to recoup this loss. And then the second reason is moral hazard. It basically means if a firm buys insurance, then the firm will have more incentive to take excessive risk. So again, this will potentially incur higher insurance payment. So the insurance firm will want to make sure it can recoup its cost by increasing the cost of insurance. Okay. Third, discuss risk management techniques the firms can use to hedge commodity risk. So we talked about several different kinds of techniques a firm can use it to manage the commodity price risk. So the first one we mentioned is vertical integration. It basically means if a downstream firm merges with its supplier, then at least partially, this downstream firm can mitigate the price risk from its supplier, right? Then the second case is the second technique is actually pretty simple. It means that you could actually use long-term inventory, right? You could store your commodity in your inventory, and this will make sure you can lock in the cost of your commodity. And then what's the third type? Long-term contract, right? It means you could sign a long-term contract with a fixed price, and because it's a fixed price in the long run, then you will be able to manage your commodity price risk. And then we go into more sophisticated techniques. So we talked about both the futures contract and options contract, right? Okay. What are the potential risks with hedging using futures contract? Well, the main problem is if you enter into a futures contract, then you have the obligation to fulfill your contract. This is different from an options contract, right? So if it's an options contract, you could just walk away. So this specific feature of the futures contract will create some risk because you have the obligation. So even if the price becomes unfavorable, you will still have to fulfill your obligation, right? So that's the risk here. That is, you cannot walk away if the price becomes unfavorable. Okay, fifth, how can firms hedge exchange rate risk? So in the case of exchange rate risk, we have basically two techniques. The first is use the currency forward contract. It's similar to a futures contract, right? So obviously, if you enter into this currency forward contract, then you can actually have a fixed exchange rate. And the second technique is to use currency options, either call option or put option. Okay, why might a firm prefer to hedge exchange rate risk with options rather than forward contract? So this one is simpler. Sorry, this one is similar to problem 4. It's really because just like the futures contract, if you enter into this forward contract, again, you have the obligation to make the currency exchange, right? So this means you have to exchange currencies, even if the currency movement is unfavorable, right? So this will create some loss because of this forward contract. Okay, 8. Why might a firm, I think we should talk about 9 here. How can a firm hedge interest rate risk? So for interest rate risk, we basically talk about 2 techniques, right? So the first is duration-based hedging. That is, you will modify the firm's balance sheet by changing the duration of its asset or the duration of its liability. And your goal is to make sure the duration of the equity is 0. And by doing this, you will be able to hedge against interest rate risk. And then the second one is based on interest rate swap, right? So you could either swap fixed rate for floating rate or floating rate for fixed rate, depending on your needs. Okay, so that's for chapters.
There's nothing in your music library.
Oops, sorry. Siri goes crazy. Oops. Okay, so that's for chapter 30. And I would say chapter 30 is the possibly the hardest chapter in this class. Largely, it's because you have to understand several financial vehicles, right? You have to know options and futures, forward contract, and interest rate swap. So I would recommend you to spend more time on this chapter and to solve the problems by yourself. And if you have questions, obviously, you can refer to the textbook, or you could email me, or you could meet me in the office hour. Okay, so let's move to the next chapter, which is chapter 31, International Corporate Finance. So we have these several topics. So first we will talk about the benchmark case, the internationally integrated capital markets, And then under this benchmark case, we will do this project evaluation, and then we will think about international taxation. Next, we will move on to this more realistic case. So we will talk about segmented capital markets, and then we will talk about capital budgeting with exchange rate risk. Okay, so let's first start with the first section, international integrated capital markets. So here we just want to use this integrated capital markets as a benchmark. And in this benchmark framework, capital markets are related and integrated across borders, countries, and different currencies. And under this benchmark, because capital markets are integrated, so the value of a foreign investment does not depend on currencies. So you can see that this is actually a pretty important topic, right? From a Canadian's perspective, you can imagine that if you have investment in the U.S., then you will have to think about the exchange rate between CAD and USD, right? You will want to understand how could you correct the value your investment in the U.S. in the Canadian dollars, right? Okay, so now let's say we're thinking about the exact same question. That is, a Canadian investor is buying a foreign asset. So this investor needs to calculate its present value. Importantly, you can see that we have the currency here. So even this is a US asset, this investor wants to know its value in Canadian dollars. Right? So this is the important part we want to focus here. And this is the difference we see here compared with Corporate Finance 1. Because we have learned how to calculate present values in Corporate Finance 1, right? In that case, or in Corporate Finance 1, calculating present values does not involve different currencies. But here, we want to think about currencies, right? Okay, so to find out the present value in Canadian dollars, the investor has two approaches. The first approach is the investor can first compute the present value of the asset in foreign currency, right? And then the investor can convert the present value in foreign currency to the present value in Canadian dollars. The second approach, the investor can first convert the cash flow from the foreign asset to cash flow in Canadian dollars. Then the investor can discount the cash flow to find out the present value in Canadian dollars, right? So to summarize, in the first approach, the investor will use cash flow. So this CFOC means cash flow in the foreign currency, right? So investor will discount the foreign cash flows directly into the present value in foreign currency. And then it will convert this number into present value in Canadian dollars. In the second approach, it will first convert the cash flow into the cash flow in Canadian dollars, and then it will calculate the present value in CAD, right? So basically, you can see that the currency conversion happens at different stages. In the first method, currency conversion happens at the second stage. In the second method, the currency conversion happens at the first stage. Right? And you can imagine if we are living in a world without arbitrage, and if law of one price holds, then these two methods should give us the same answer, right? In the end, this present value in Canadian dollars from the first method should be the same as the present value calculated from the second method. Okay, now let's first start the first approach. That is, we're looking at this. Right? And in the first approach, the investor will discount the foreign cash flow into the present value in foreign currency. And here, the investor will use the discount factor in the foreign market. So this discount factor is written as RFOC with a star. So this number is the cost of capital in the foreign market. Okay. Now, the second step, the investor will want to convert this present value in foreign currency into the present value in Canadian dollars. So how the investor can do this? Well, the investor can just use the market exchange rate or the spot exchange rate, right? So let's assume S is the spot exchange rate. To be more specific, S is the spot exchange rate in Canadian dollars per foreign currency. It means if we are thinking about US, then this S is S Canadian dollars per US dollars, right? So, because we know that we have present value in foreign currency, now this number times S, we will have the present value in Canadian dollars. Of course, we know that the present value is given by this guy. So in the end, we will have this formula, right? Again, this one is very simple to understand. This is just present value in foreign currency, right? So as I said, this is a very simple two-step process, right? First, discount the foreign cash flow into the present value in foreign currency. Then you do the conversion. Now we think about the second approach. So now we think about the second approach. Right? In the second approach, you will first do the conversion. You will first convert the foreign cash flow into the cash flows in Canadian dollars, and then you will do the present value calculation. Okay, so now the Canadian investors will convert the foreign assets cash flows into Canadian dollars. However, the investor can only convert the expected cash flows in the future into Canadian dollars, which means this investor cannot use the spot exchange rate, right? So if you think about the timeline, it's like you have, let's say the cash flow will be paid in the next period, right? So now you're here. So obviously, what you can get is just the expected cash flow. And the spot exchange rate S cannot be used to convert the expected cash flow in foreign currency to the expected cash flow in CAD, right? What you need here is the forward exchange rate. So again, this forward exchange rate is quoted as Canadian dollars per foreign currency, right? Because we have learned about currency forward. It basically means as an investor, if you enter into this contract, then you can have a fixed exchange rate in the future. And this fixed exchange rate is given by F, right? So this means the Canadian investors' expected Canadian dollar cash flow is given by the forward rate times the expected cash flow. And next, this Canadian investor will be able to discount this foreign cash flow denominated in Canadian dollars into present value denominated into Canadian dollars. So in this case, if you look at this denominator, it is in Canadian dollars. So to discount this denominator, we should use the cost of capital for a Canadian investor, right? So in this case, we use RCAD to refer to the cost of capital for a Canadian investor. As I said, if this is a world without arbitrage, law of one price holds, then the value we get from the first method should be the same as the value we get from the second method, right? Two methods should give us the same result. And you can see that this is the present value we get from the second method. And this is the present value we get from the first method. So this should be the same. And if you simplify this, if you do some algebra, then you can see that in the end, it can be simplified as this. So if you look at this formula here, right? If you look at this guy, it is very similar to the covered interest rate parity we learned in chapter 30. So let me show you the covered interest rate parity. So the covered interest parity says forward rate equals spot rate times the risk-free rate in the US divided by the risk-free rate in Canada. And now if you compare this covered interest parity with this formula, then you can see that they're very similar. The only difference is in the covered interest parity, you're using risk-free rate. Right? And here, for this formula, you're using cost of capital for your project. Right? Okay, so to summarize, so basically with internationally integrated capital markets, that is, in this market, any investor can exchange currencies at the spot rate or forward rate. Again, don't confuse it by forward rate. It basically means your exchange rate is fixed in the future at the forward exchange rate. And this investor is free to purchase or sell any security in any amount in any country at its current market prices. Then in this case, the law of one price holds, and the value of the investment does not depend on the currency used. So that's for today's class. Next class, we'll solve this very simple example and then proceed to other sections.